Let me go tell Ryan. Hang on. Now it's live. All right. I'm going to hang this up, George, okay? So, expand the limits, go limit, right?
Yeah, it's the old lumber telling the CME, hold my beer here. We'll show you.
Well, just when you thought lumber was the coolest kid in the block, you throw nickel into the mix.
Yeah, I've got some other commodity charts to reference today where our volatility is being shared just about everywhere now.
Well, it's almost being dwarfed.
Yeah, no, the nickel one, and I don't even think the chart that I have here reflects. I think it went to 100,000 today.
It
I
did.
guess Chinese, some kind of Chinese hedger got caught and just completely took it from 50 to $100,000 here.
It's amazing. What's that? Oh,
Uh-oh.
that's my. Ooh, that was horrible.
Are we a go here? We're live?
Yeah, let me stop my share. Um, we are, but we were. So I flew in from Florida this morning. I was down at the NOLA Leadership Summit.
Yeah, I saw you. You look tan. I saw you outside yesterday in your fancy shorts. It was on. You posted on the LinkedIn.
Yes. Um, well, I hope I don't look tan. I put on my sunscreen. I was trying my best to.
You look
Uh,
healthy. How about that?
there we go.
Yeah. You don't have
Well,
that pale white Chicago glow right now.
now it's so funny when you go to Florida this time of year, and you see the people that are there all the time, right? They got a healthy tan going on, and then you got us pasty whiteys from the north coming in, and we look, translucent almost.
Yeah. Yeah. Take your vitamin D supplements if you live in the Midwest or the Northeast. That's for sure.
Um, but the weather was lovely. Very small crowd. So what I didn't realize, very few Canadians. Um, Coming to the United States is risky getting back for a Canadian because if they come down here and then they have to get a COVID test to go back.
Yeah.
If they get a positive test, they're stuck here.
I think they have to, or go into quarantine for 14 days. It's a little bit more strenuous than here right now.
I don't know what they had to do,
Yeah,
but
I
14.
know that it's continuously changing. I'm going to Toronto in 2 weeks, and I know to cross the border now, I think you just have to have your vaccination card to go into Canada versus having a negative test. I think they changed it to where you just have to have your vaccination card now.
Right. I think they said that the locals were saying it's harder on the Canadians than it is on the visitors.
Yeah.
Um, all right. Well, look, we've got some people on YouTube. We've got our friends on LinkedIn. Oh, I thought I did. Oh, I don't want to do that. I want to view as a member. I think we're pretty much ready to go here. Yeah, there we go. We got a crowd. Let's get this started. Hello, Greg Kuda. Welcome,
Hello.
everybody. It is live lumber futures from the free seats on Tuesday, and never a disappointment. We've got lots to talk about. Greg, kick us off. What do we got going on?
Well, I figure we'll do our usual review in lumber, but I also wanted to include, I posed the question on the LinkedIn, inviting people to watch us on LinkedIn. Is lumber reflective of other physical commodities, or is it more reflective of equities, economic conditions? And I've got some charts to kind of lay it out. And I don't have the answer. I more or less just
Well,
posing it to the
the
people
answer
watching
is
here.
yes.
Yeah. The answer is
No,
both.
and maybe.
Yeah, pick a day, but lumber is no longer solely hoarding the volatility, where the volatility is spilled out just about in every other market. So we'll jump in here. So again, just a reminder, we have zero limits in March because it's the spot month, and then we have limits now of $57 and $86, and joking with Mike here before we started. Lumber did its hold my beer and went limit down today. So 2 days in, we've had a limit move of $57. We're limit down today. So it never ceases to disappoint here.
No, and then going in, you talked about March being no limit. Going into today, the open interest was 154. Now, anyone that is looking at the regular trading volume of yesterday, 25 cars went through. I didn't look on the website. I'm guessing those were EFPs.
Yeah, there were. Let me jump forward here. I'll do the EF. So I'm going to bounce around here, but lots of stuff. Here we go. Let me go back. So here's EFPs. We did 25 yesterday, Mike. So month to date, we are up to that 176, which is we're actually up to 191 as of this morning. The 25 doesn't, so 191, and I'm sorry. This reflects, I think, month to date, total March total to date. So since the inception of March, we're up to 191 EFPs.
And for those who have joined us since we did the show on EFPs, and EFP stands for Exchange for Physical. It is a transaction that happens outside of the trading environment, where two offsetting, a long and a short, come to an agreement and actually ship a physical rail car of lumber. So it's not exactly a delivery, but it is a delivery. Someone got a rail car of lumber based off of what the futures contract is. And we'll cover that again in the future, but just so people understand it, what an EFP is, of course.
So I'm going to jump back up here and let me share. Am I still sharing the screen? Let me go back into slideshow. Okay. All right, so we've looked at this now over the last month, and I took crude oil off of this just because of it's so far above the charts. You wouldn't be able to read this. So I asked the question: is lumber more a function of the equity markets, economic conditions, or is it more a function of a basket of goods following aggregate commodities? And again, yellow line is lumber. You can see obviously the S&P, the Dow, and especially the NASDAQ have all had substantial sell-offs from their peaks now. And when we look at interest rate, 10-year notes, when we initially had this plunge last week with the Ukrainian situation escalating, believe it or not, the 10-year note had sold back off to a 166 area after making a high water mark of 204. As of this morning, it was back up in that 185 area. So again, this just puts a lot of pressure on the Federal Reserve in that, the markets are saying there's a lot of risk, inherent risk now because of what's going on in Europe, and commodities are kind of a runaway freight trains, suggesting there could be stagflation. Dare I use that word? So there's a lot on the Fed's plate here as far as dealing with the now versus dealing with the future. And then I'll jump forward. Here's front month crude oil. Yesterday we made a high of 130.50. This morning, April crude oil, and this is WTI, Western Texas Intermediate, made a high of 129.44. It's back in the 122 area right now, but you can see we're within striking distance of 147.27. That's the 2008 high. When you adjust this for inflation, if you're going to actually go take out this high adjusted for inflation, that puts crude somewhere in that 175 to 190, 195 area. So that's the kind of potential, upside potential, where you could easily blow through this high and trade substantially higher than what we saw back in 2008, just adjusted for inflation. So here's, I'm sorry, Mike, go ahead.
Ever since the experience we had with lumber blowing through highs and going to, 3 times the highest or 2 times the highest it's ever been, I have a whole new respect for what are the real pricing bands. Meaning, what is the all-time lows? What are the all-time highs? What do they really hold? I think we could be in a unique situation here where oil could just blow through those all-time highs.
Well, and you look at the, what the low end was. Historically, the low end of crude was $13. Well, we all know what happened during the pandemic where crude went to negative $40. So the idea that history is some kind of precursor of where we can go to continues to be blown out of the water left and right, and not just lumber, but in a lot of these other markets. And fast forward here to here's Brent crude oil. So this has gotten up into the 132 area. Again, this is European oil. So this has, I'm going to kind of get to this. Here's natural gas. So this is Euro natural gas. You can see, from the beginning of March, it was at about 75 cents, 75 cent. This is in euros. It traded up over $2.25. Again, this is denominated in euros, but you've had this massive push higher where, I've got a Euro mill, and he was telling me that Austria and Germany import 80% of their energy needs from Russia, both natural gas and crude oil. So Europe is much more at the mercy from an energy standpoint, from a grain standpoint, ag standpoint, at the mercy of Russia and the Ukraine. And so here's gold. Gold did make a new high here. You're up over 2,000. It actually surged up to 2,082 today. If we jump forward, here's palladium. Since the low back in November, palladium's up almost 100%. There's a lot of palladium in the Ukraine, obviously in Russia. Here's nickel. We talked about this, and this doesn't even. I want to say this traded up to 100,000 today. So you've gone from, at the beginning of the year, this crisis, you've gone from the 20,000 area up to the 100,000 area, where the old high here of 50,000 was rendered useless. I mean, it just completely exploded through there. Here's lithium, a massive trend upward. Here's wheat. Wheat basically tested its all-time high, or got within 20 cents. This 13, I think the old high was 13.43 back in 2008. So again, wheat's up here. I guess Ukraine is considered the breadbasket to Western Europe, where they supply a significant amount of wheat into Western Europe. Same thing with corn. Here's corn. Again, you're basically within striking distance of all-time highs in this $8, $8.25 area. So you have, let's see here. So if you look at the last month, here's the energy complex. Here's VIX. So VIX, everybody sees S&P 500. This is volatility. So volatility is massively increased, and then you see your grains, your energies, palladium, soybean. Lumber is only up 17% over the last month. It's a puppy dog relative to all these other commodities. So you've had this spillover of volatility into basically all these other markets now.
Absolutely. So I have a comment about this, but I'll talk about it when we get back to lumber. So let's keep.
So I just the last one I want to point out here is what lies ahead for Europe, and you can see this is the Euro Stoxx 50 versus our mini S&P 500. This is kind of their benchmark indices from a future standpoint. You can see how it basically is tracked all along here, and then as this situation escalated, you've had this complete collapse of European equity markets relative to our market is sold off, but not nearly as severe as the Euro stocks here and the other Euro equity markets. So it just begs the question, and let me go back here, what lies ahead for Europe, in that the reality is Europe is probably headed, even if this were to end tomorrow, a lot of this damage is already done from an infrastructure standpoint, the Ukraine, the idea that you're going to have crop disruptions, you're going to have natural gas energy disruptions. The probability is Europe is heading for a recession. The severity, time will tell, but it's tough to envision a scenario where Europe doesn't see significant growth depreciation, and actually where you could have an official recession in Europe at some point this year. So that's kind of, I'll get off my soapbox here. This is kind of a state of affairs of what's going on everywhere else, and then we can jump into lumber.
Well, you're bringing up a lot of very interesting information, which normally would be second and third derivative information. But this is the tail that's wagging the dog right now. These more ancillary type indicators have become the primary indicator of what's going on. So I think this is important. As a person in the lumber market, you have to really dig deep today and figure out, okay, if that's happening in that sector, why is it happening there? How's it going to affect the lumber sector?
Yeah, and I think, at the end of the day, this all rolls back into the Fed has got a very difficult task ahead of, okay, how significant is this a short-term aberration, versus dealing with inflation, dealing with interest rates, and allowing them to float where they belong without completely annihilating the market. And when you start to factor in the cost of energy, the cost of goods likely continuing to see a significant appreciation to the average consumer. The one chart I forgot to add here is just CPI, Consumer Price Index, and consumer sentiment, consumer spending. How does that start to impact not only, globally, Europe, Asia, these other areas that are probably a little bit more price sensitive because geographically where they're located, but what's the trickle down effect to us in North America? And to say that this doesn't have an impact, if if your core goods spending is going to go up dramatically on things you have to spend money on, that certainly has an impact on discretionary income and discretionary spending. So again, something to watch as this continues to play out here.
Yeah, it's it's a big deal. The beginning of every economy is the core raw materials.
Yeah, absolutely, absolutely.
And
Um,
it's even the beginning of the technology raw material, which is electricity. So just to run software, you need electricity. And that electricity comes from a core raw material, generally a coal, a natural gas, an oil. So
Yeah, no, absolutely. And not only, you talk about developed world nations. Well, you've got a lot of emerging markets like India, Africa, areas that are much more price sensitive, to these fluctuations where it can be catastrophic from an economic standpoint, especially coming out of a disaster of a pandemic. This is the last thing. A lot of these countries, developing areas, this is the last thing that they needed to have to deal with a massive expansion in pricing when it comes to core commodities.
so I want to make a comment as we transition to let's talk lumber. And my comment is there's times like this where the volatility is high and you get nervous. And now is the time when you need to look for opportunities. This is, while of course you want to respect the risk, but you also need to have a plan here. A what if? What if we went to this level? Would I like to participate there? And things happen so fast and they don't stick around long. So these are times where you need to plan ahead and be prepared to have an order in the market or get an order into the market to make a trade. So
Yeah, and like just kind of touching back on the energy sector, I have sawmills on the books that have hedged their energy. I've got guys that have hedged their trucking fleet as far as buying heating oil or unleaded gas for the next 2 years. When you had that big collapse in the energy pricing, you had people buy crude oil, had people lock in their propane costs, natural gas costs, heating oil, RBOB costs, where if you were a lumber sawmill, if you were a lumber operator that has a trucking fleet, you were able to fix your energy costs, for 2021, 2022 and beyond. So there are people that not only just trade lumber futures, but a byproduct of being a lumber company, whether it's a sawmill or a distributor or somebody in between, is that you do have people look at these other markets because you do consume other commodities and you have a way of fixing those costs. And people do utilize, whether it's through me or Stone X or, Alex, there are people out there that look at these other commodities and do something about it.
absolutely. So with that in mind, let's go to Lumberland. What is going on?
Yeah, so I think here's your continuation, and we obviously made a new high in March. I'm not going to dwell too long Here's your price curve. And I think, if you were to look at this versus last week, you had a flattening of this curve, and it's more evident. Here's the March daily chart. You can see we gapped, from yesterday's close, we had a gap. So is this some kind of island reversal? Time will tell. You're breaking out of this coil formation. We'll see as you get into the 9-day area how significant this is as far as support. But jumping forward, here's your March basis a week ago. March was basically at a $43 discount to physical cash. Today, you can make the case that March, and this was as of this morning when we opened at 1410. You can make the fat finger there. You can make the case that okay, cash is a 1400. March is basically within $5. Last trade is 1396. So you've had convergence with March here. When you jump forward to May, a week ago, May was at $186 discount to cash. We've seen a significant narrowing over the last week, where the back months, being led by May, have had this major charge to the upside to narrow that gap. Where May has traded as high as this, I think we got up to 1336.90 yesterday. And same thing in July. A week ago, July was a $325 discount. Today, it's back into the 243 area. It's still substantially wider than historicals, but it is starting to narrow in. March-May spread is still relatively wide, and this spread is likely to remain wide on any weakening structure in lumber, because March is going to have a more difficult time selling off relative to cash. You're more likely to get that sell pressure in the back months speculatively. So today, that spread, the March-May last trade is a 160. I think it's traded as narrow as the 110 area last week. So it's kind of vacillated in that 110 to 160-ish type area here.
Yeah, it's 155 offer right now, so I think it's probably closer to 150 right now.
Yeah, it's 140. Yeah, 146.70 at 155. Which is still wide. When you compare it to last year, you topped out around the 2nd of March last year in this 158 area. You had a collapse back into this 90 to 75 area before it kind of got blown out the last 2 days of trading. It went back out to that I think 155, 160 area. So you jump forward now into the May-July spread, and this is the intriguing one to me, where this March-May spread.
March-May, yeah.
Oh, I'm sorry. I was one chart behind here. This is the March-May from last year. So here you topped out in the 158 area on March 2nd. You narrowed into the 90 to 75 area here, and then I'm sorry, I'm having okay. And then the last 3 days of trading, you got blown back out into that 170 area. This is March-May of 2021. This is last year's spread. So it's kind of similar. It's similar in that it's still a wide spread structure this year relative to last year. Jump forward to May-July. Here's the current May-July spread. It's traded out into this 155 area. When you compare this versus last year, I'm sorry, here's, I'm sorry, here's last week. Okay, this spread was in the 135, 140 area. Fast forward to today, you've kind of flatlined in this 155 high area. And then when you compare it to May, July of last year, interestingly, if you go back to, you were basically in this 75 to 80 area a year ago. You did not trade out until the 140 area. You were basically into the end of April. You're almost 6 months from now before this spread got out into that 150 plus area. So this spread, when you go back to what it's doing now, is significantly wider than a year ago. Is this a front spread or a back spread at 150 over? Boy, that looks like you don't want to sell May. This looks like a pretty good sell opportunity to start to build some kind of a short position.
This to me, this spread is key. If I'm watching the market, this is what I'm going to be watching for an indicator. Um, I hate selling things that are moving higher, but I would watch this spread pretty closely. We're going to get to a point where this looks like a juicy sell, in my opinion.
Yeah, no, and it's just tough to, like, okay, certainly it can go wider, but what's the justification, for an industry that doesn't know what it's going to do 2 weeks from now? The idea that, we're going to forecast May relative to July and justify this kind of premium in May seems a little extreme, where when this ultimately does top out, you could have this collapsing structure play out in 2 or 3 days where the spread could come back into 100 to 70 over off of very few trades to do it.
Yeah, for sure. I mean, just put yourself in a fundamental position on this. If I need to buy in wood for a project, and that project is going to start before July, or before August, yeah, I'm going to be pushed into that May contract. But if it's an if it's a long-term project and I need wood for the fall, I'm not going to buy May wood, and I'm not going to buy cash wood. I'm
No,
buying.
and so I'm going to jump back to this real quickly, and then I'll spring forward here. But this curve here, tells you when you look out along the curve, you get out to July, September, and then you kind of flatline into November, January of next year. If you're if you're quoting these jobs, and if you can sell today's price levels and then buy forward for when you're actually going to take delivery of the wood, this is a no-brainer trade. You want to short this number, you want to buy this number, and let the convergence play out. So the forward guys out there, this is the prime opportunity to short cash jobs here based upon today's numbers, and then go get the coverage along the price curve of futures, depending on that time frame of when you need the wood. But no,
So
this represents the further out you go. Again, if you're going to be wrong lumber in November at 988, you're not going to have this massive bloated premium in these front months, where you're going to see this price curve flatten out at some point here.
yesterday I was at a convention, and I was at lunch at a table with a sawmill who has production in Canada and in United States, and we were talking a bit about the market. And I said, I'm just curious, if this was 2 years ago and I said you could sell at essentially $1,000 FOB, Prince George, for the rest of this year, would you sell all your inventory? And they just laughed and they said, yeah, of course. That was right after they said that $1,000 is too cheap. They wouldn't sell there. So, when you take a step back, and of course, everybody likes to make decisions based on what's happening in their world today. But the reality is these are phenomenal high profit prices for all these mills. And there's no reason why they shouldn't be hedging into those back months.
No, and again, Mike, it all like, why are we here? Are there legitimate supply constraints that are more long-term in nature? Is this a demand-driven market? And again, at the end of this, you're going to have the fundamental demand justification to support these higher numbers. If this truly is a supply constraint issue, logistics, transportation issue, then the market will inevitably call that out, and you'll float back down to reality. But you're going to have to, over the long haul, you're going to have to justify these higher numbers with underlying fundamentals. And given what equities are doing, given what's going on, what's likely going to happen with interest rates, it's just tough to drink that Kool-Aid right now that, there's only tailwinds out there. There's no headwinds. That's a dangerous assumption, especially at these elevated price levels for a sawmill. Why wouldn't you capture some kind of elevated number and build out your order file beyond what you have in the physical cash market?
Absolutely. 100%.
So a week ago, we kind of were in that 2,800 area, 2,757. Fast forward, we've lost open interest here. We're down to 2,467. Now, most of this can be explained with, obviously, March went from 579 down to 154. but you basically stopped that continuous build of the back month open interest. Instead of seeing March just transfer into all these back months, you just saw more liquidation of March where we've kind of stalled out where, and when I jump forward to the CFTC numbers a week ago, managed longs added 70 contracts. You had shorts, you had longs. When you look at it this last week, those managed longs only added 13, and you had profit taking here. You probably had guys again liquidating their March longs, and then just going into physical cash, and that's kind of reflective of these producer longs liquidating, and even some of the producer shorts. This is probably more a function of just March liquidation, and not needing to transfer it into May, just dealing with physical cash, the liquidation of March and moving it off into the physical cash market.
Yeah, if you're a sawmill, you just sell, get as much order file as possible until you run out of order file to get, and then you may look at May for a hedge.
Yeah, absolutely. I'm not gonna. Just wanted to show this. This is something that Alex builds at Stone, and it's a great chart, but it just shows you your here's your market volume, and you can kind of see how we had spiked up and then we've kind of settled back down, which isn't surprising. The other thing, I know there was a lot of apprehension going into the expanded limits here the last couple of days, where I think you know last week in anticipation of limits being expanded, I think a lot of guys were interested in getting a smaller position, just something that was easier to manage, giving the $57 limits. So that kind of reflects on how open interest has started to open interest and volume has kind of trended down going into this price limit expansion.
Yep.
Last thing, Mike, is just rail cars. So again, car velocity seems to be improving. Unfortunately, you're not seeing it in Canada, where you're almost back at the lows, and for whatever reason, and you'll get a bevy of answers when you talk to Canadian sawmills, the rail situation is seeing limited improvement week over week, where I think when you talk to most sawmills, they're not very optimistic. They think it's at least 4 weeks, 6 weeks, 8 weeks before you see complete normalization with the CN. And again, you jump forward into US rail statistics, and you're much more in line with where you've been historically the last couple of years. But for whatever reason, Canada still continues to struggle to move wood out of Canada. Once it crosses the border, it seems much more normalized, but getting wood out of Canada continues to be easier said than done.
Quick question for you. I'm curious about the rail speed and the rail traffic. Canada is known as a wheat producer, correct? They have a bunch of grains in the middle of the country.
Yep.
Um, if wheat turns out to be the new gold, gold amber waves or golden waves of grain, we start exporting more wheat out of central Canada. Do you think that could mess up the rail traffic for wood later?
I think it's certainly given the CN's MO. The answer is yeah. Until they prove otherwise, they seem to be extremely mismanaged. I don't think weather is an issue now. It seems to be a function of lack of infrastructure, lack of employees. And again, when I asked the sawmills, and I probably talked to probably 10 to 15 different sawmills last week, both Eastern and Western, and I ask people, well, are you seeing these other issues with other commodities? No one really had an idea. You have to remember that rail cars are center beam rail cars, so they have one use: it's to haul lumber. They're not grain, cars that can be converted into grain cars or tanker cars. So, is it a function of the industry doesn't want to pay fair market rate? I know that there are certain mills that are more willing to bid on extra cars from the CN versus other mills not wanting to do it. It certainly has the feel that Canadian sawmills aren't doing everything that they possibly could be doing to alleviate this issue. If somebody wants, you wouldn't bid on extra cars if somebody else is willing to pay for it. You wouldn't allow somebody to pay for their own truck to get wood out of there, where they're just, the more people I talk to that deal with the CN, the more convoluted it seems to get, where there isn't a clear answer as to what the problem is outside of the fact that it's basically a monopoly, and there doesn't seem to be much accountability at the provincial level, at the government federal level, as far as any accountability, and how that this isn't a one-off event. This has been going on since 2018, and it seems to be getting progressively worse with the CN. And there don't seem to be any real answers out there as to why. It's just you have to deal with it, and that's it.
Yeah. So we're bumping up on our half hour here. One of the things I like to point out, we talked a lot about other commodities and these kind of external factors. Supply demand generally in the United States is pretty well balanced, and it seems to be the outside supply sources that will keep everything in check when it gets a little bit out of whack, which we see the European wood coming in, right? And that's kind of what's holding us in check in this high demand market. Now, previously, the market would move up when China had a bunch of demand, and a lot of that wood off the west coast of North America went to China. One of the things that I'm going to be keeping my eye on is, if China absorbs the excess wood coming out of Russia that would have gone to Europe, and then if Europe, keeps onshore a lot more fiber, how is that going to play into the pricing? Are we going to see more West Coast species available here in the United States, or are we going to see, less fiber hitting the eastern seaboard from Europe?
Yeah, and so the other thing that I think is interesting when it comes to Europe, obviously there's a lot of Russian logs that don't necessarily make their way here, but they obviously stay in Europe. They go to Asia. So if there's going to be this Russian log ban, import ban, obviously that's probably more wood that goes to China because it's got to go somewhere. The thing that I find interesting with Europe is if they're on the precipice of going into a recession, a severe recession because of what's going on. I know underlying demand in Europe has been extremely strong. It's kind of mimicked the demand here, where there isn't this big incentive to just dump all this wood here, because staying in your own market, is paid handsomely for European producers. So the question I have is, do you start to see a consumption slowdown in Europe first to where, it's conceivable? Do you see more European wood come here because there's less consumption back at home? These are all the, balls you have to juggle as far as trying to analyze aggregate global demand, aggregate, global supply, with everything geopolitically that's going on. It's just one more wrench in the works in trying to figure all this out.
Absolutely. I do know that in a recession, lumber demand tends to go down. That's
Yeah.
kind of a simple one. So let's, bring everything back to head here. What's going on right now? We're limit down in May and July. If everything stays the same here tomorrow, the limits will get expanded to $86, correct?
Yes.
So we're 1245. $86 off of that is going to put us at we could be down at 1160 tomorrow.
Yeah.
Then you go $86 one more day, you could be down at 1080. I'm just throwing out scenarios. We literally could be at $1,000 in 3 days.
Yeah,
So,
and that's the design of these, to allow the market to, price discovery 101, to allow the market to float where it thinks it belongs. And, it certainly is not for the faint of heart. But again, just lumber traders, you're not alone, that the volatility is extreme in just about every other market out there right now. Especially
but
all the other physical commodity markets. They're taking notes from lumber traders here on how to deal with the volatility.
now, and it's just as I'm saying, lumber could be at $1,000 in 3 days. It also could be at $1,500 in 3 days.
Absolutely,
So,
absolutely.
knowing that, you need to plan your trade. And if $1,000 makes sense for you on a business to buy lumber, you might consider being ready for that. And if $1,500 makes sense for you to be a seller of lumber, you might need to be ready for that.
No, and I think, Mike, you hit the nail on the head. The start of the show. What's your plan? And everybody has to have a plan here based upon your risk, because the volatility is not going to get bled out of any of these markets anytime soon. So have a plan and understand, your plan's got to be predicated on where your risk is and act accordingly.
Absolutely. So shameless plug. I love it. This,
Yeah, no, I think, Alex and I, we did this last fall. It's a great success. So this is a physical, in-person risk management seminar. It's at Stone's headquarters in Kansas City. The 27th, 28th of April. We'll have more details, but it's open to all industry people. And it's basically Futures 101. One of the guys that teaches this from Stone, a lot of Stone's educational people have come directly from the CME, Chicago Mercantile Exchange. So they're really good at explaining basic concepts and then relating it to lumber. So I think for those that kind of know that they should be doing something but don't necessarily know how to do it, this is a great, kind of get your undergrad, graduate degree and risk management all in one fell swoop here.
and what I would encourage is if you have someone in your organization who you have targeted to move up, get them learning about this early on and let them start watching the markets with a different understanding, with a better understanding.
Yeah, absolutely. Absolutely.
I couldn't recommend this course enough. All right. So that wraps it up. We'll see everyone next Tuesday. Never a dull moment in lumber. If anyone has any questions, or if you want these slides, like we said earlier, we will provide the slides for you. We're all about it.
I did have people reach out last week asking for slides, so by all means, just let me know or let Mike know, and we'll get them forwarded. And more importantly, and I see somebody's asking the cost. I think it's around $300 for a 2-day event. And that's just to pay their costs of having people come out and teach this. But they will have definitive details that I'll forward on to everybody, hopefully in the next week or so. But the other thing I wanted to stress, if anybody wants to see something, hey, talk more about spreads or the mechanics, get back into options, whatever people want to see, then by all means, Mike and I are more than happy to discuss and talk about. And that, if there's something out there that you want to know about, that just ask us. We're more than happy to talk about it.
And if you like this content, Materials Exchange would appreciate your support. We're able to put this on because we're here operating an exchange. And what we would appreciate is just, at a minimum, give us a look. We're transacting every day. And if things are buying and selling on our platform, that means they're the market. So
absolutely,
there's good opportunities on the Materials Exchange platform. But enough shameless plugging. Let's everybody have a safe next week. We'll see you on Tuesday. And thanks for joining us.
Thanks a lot, Mike. Thanks, everybody. Take care.
Have a good day, Greg.
You too.